Automated market makers is a financial tool unique to Ethereum and decentralized finance, DeFi. In this video we shall explain what is automated market makers. In a traditional exchange platform, buyers and sellers offer up different prices for an asset. When other users find a listed price to be acceptable, they execute a trade and that price becomes the asset's market price. Stocks, gold, real estate, and most other assets rely on this traditional market structure for trading. However, automated market makers have a different approach to trading assets. Automated market makers, AMMs, allow digital assets to be traded without permission and automatically by using liquidity pools instead of a traditional market of buyers and sellers.
AMMs have become a primary way to trade assets in the DeFi ecosystem, and it all began with a blog post about on-chain market makers by Ethereum founder Vitalik Buterin. The secret ingredient of AMMs is a simple mathematical formula proposed by Vitalik as token A multiply token B is equal to K. The constant, represented by K, will determines the price of tokens in a liquidity pool.
For example, if the initial liquidity pool has 100 Bitcoin and 100 Ether, then K will be 10,000. If someone buy 20 Bitcoin, then Bitcoin will be reduced to 80 and the amount of Ether can be calculated by 10,000 divided by 80 and give 125 Ether. Then the price of BTC will become 100 divided by 80 and yield 1.25 as compared to initial price. On the other hand, Ether price will become 100 divided by 125 and yield 0.8. Every time Ether is bought, the price of Ether goes up as there is less Bitcoin in the pool than before the purchase. Conversely, the price of Ether goes down as there is more Ether in the pool. The pool stays in constant balance, where the total value of ETH in the pool will always equal the total value of BTC in the pool.
This concludes the video. Feel free to comment if you like this video. Please like and subscribe to our channel.